Hello, Professor.
Hello, how's it going?
I'm
So
doing
I
good.
I decided not to come in today because I didn't want to cough all over everyone. So, but we can still have our session. So this is going to work out very well. Um, Hopefully some of you got to save some time driving in because if you're commuters. But anyway, so here's what we're going to do. So I meant to do this last time anyway. We worked on that spreadsheet, asset allocation. Actually got pretty far with it. But there's something else at the end that I wanted to do. And so here's what I would like you to do. Why don't you open up that spreadsheet you sent me the other day? And we're going to add more details to it. But just to be on the safe side, why don't you save it as with today's date on it? So that way I know which ones have this new material and which ones don't. All right. So in other words, open it up and then resave it with the name, same name, but with the date attached to it, February 12th. That way I'll know those are the ones that have the fourth sheet filled out. In other words, the time value of money content. So this is something that I'd hoped to get done the other day, but we kind of ran out of time. So I collected we did the first three sheets and I collected that, but there's more that we didn't do. So in order to tell them apart, uh, I would like you to, save this file by adding the date at the end. And so that way it says chapter 2 asset allocation, but then it also says February 12th, 2025. Great. Okay. It just helps keep me organized. That's all. All right. Anyway, so what happened here is that I noticed that in the assignments that they ask questions about the time value of money, which I guess they're assuming you've already seen this before, but I don't think it's a good idea for them to do that. I would like to go over it with you quickly one more time in case this happens again, so you'll have some refresher about how the time value of money works. And also, in case you've never seen it done before, how it's done in Excel. I mean, that's kind of a big deal. So you may have done this algebraically before, but possibly you've never seen how this is implemented in Excel. So for that reason alone, I think it's a good investment of our time to work on this. So what I did was I wrote some additional notes. If you go into Brightspace, you'll see them there. Let's see. Now I got so much crap. Here it is. Here it is. So if you look down here where I have appendix. Okay. All right. Anyway, so what I'm calling the appendix is where I put my review of the time value of money. So let's get that open. We'll quickly run through the notes. And then what I'd like to do is run through the examples in Excel, and then we can go on to the new material. Now, by the way, it's one thing I do want to remind you. I got an email from the school the other day, and they said basically, not everybody seems to know it, but we're off next Monday. Apparently, they're going to have President's Day off. I didn't really notice it in the academic calendar. Let me just go see if it was there. Maybe they just changed their minds. I don't know, but they wanted to make sure that we told everybody to be aware of the fact that this coming Monday is a holiday. And all right, so let's see where are we? Here it is. Oh, that's full. Okay. Wait a minute. Where's the spring? Oh, it's way down here. Okay. Here we go. Here we go. Um, hmm. Oh, it does say that. All right. Well, then what were they talking about? It says right here in the calendar, Monday the 17th, the university is closed. All right. Well, I guess maybe I forgot all about it, but they sent out an email just to make sure everybody remembers that we're off on Monday, because I guess this is something they're trying for the first time. I don't remember if they've ever had President's Day off before. It's possible that they decided to do it for the first time. But anyway, with all that being said, what I've done here is I've gone into MindTap because we're missing a day and because we're maybe just a little bit behind. We haven't started chapter 3 yet. When I went into MindTap and I changed the due dates for the chapter 3 assignments, So I'm going to show you what I've done. And basically what I did was I gave her an extra week. Okay, so under the circumstances, I don't think it would have been right to have you do this by Sunday night because, we may not actually finish chapter 3 and because of that extra day off. So here we go. Hold on one second. Let me just show you. Now, before, until like this morning, the chapter 3 problems were due this coming Sunday night, but now nothing is officially due this weekend. I just moved them into the following week. Now, I may have to take some of these and push them up the following week too. In other words, right now you've got 4 things due on the 23rd. It might be a bit much, so I may take some of these and move them up to the following week. But as of right now, nothing is actually due this weekend. That doesn't mean you can't start it, but it means it won't be due until next Sunday. And partially because, let's say you've made some plans for the 3-day weekend. I don't want to ruin that. But so this way you have the option of working on them now if you want to, but you don't have to. Okay. So I just want to make sure everyone is aware of this. Very good. Now let's get back to where we were. So I'm going to show you this appendix one more time and we'll just quickly review. And this should be something you've seen before, but possibly not for a while. And this is the time value of money. Specifically, what we're after is calculating the present and the future value of a sum of money and or an annuity. Okay, and then I'll show you how that's done in Excel. All right, here we go. So the whole point of the time value of money is that we're trying to explain how much more valuable it is to receive a sum of money now than at some point in the future. Okay, and of course the logic here is that the sooner you receive a sum of money, the more interest you can earn by investing it. So if you have to wait to receive your money, you're going to lose out on some of that interest. So with the time value of money, what we can actually do is figure out the value of having a sum of money at different points in the future or today. So we will illustrate a lot of these concepts with the.
Did you go back to the other side?
Oh, yeah. We're going to illustrate a lot of these concepts with a special type of graph, which is called a timeline. And on that timeline, we're going to basically just show when the cash flows take place. So that way you can visualize what's actually happening. Because in these cases, the timing of the cash flows is really the most important thing. Okay. So once we've done that, depending on the problem, we can either solve for it algebraically, which I'll show you how to do, or else we can do it with Excel. Okay. So all right, actually, let me just get my calculator out real fast. Hold on a second. All right, so are we ready?
Not yet.
All right, let me know when you're good.
Almost. I'm good.
All right, so this is a simple example. Now, you notice here, this is a timeline. Now, what I want you to notice here is that the numbers represent years in the future. 0 is meant to indicate today. 1 means next year. 2 is 2 years in the future, all the way out to 5 years. The positive numbers mean cash inflows, and the negative numbers mean cash outflows. So in this case, I've somehow found an investment that enables me to invest for $1,000. And in exchange for that, I'm getting $500 a year for the next 5 years. So that's a pretty sweet deal, I must say. But if those are the cash flows that's what we need to take into account when we calculate the present or the future value of this investment. Okay. Now, by the way, just to get ahead a little bit, if the cash flows all equal each other, like they are here, then this is a special case called an annuity. And the word annuity simply means a series of repeated annual cash flows. We'll see why that's so important later on, because in finance, we often find certain types of securities tend to make payments in this form where there's a regular series of payments that are equal to each other. Also, when we borrow money to buy, let's say, a house or a car, the payments are actually all the same. And so those can be treated as a type of annuity. So we'll see that there are formulas that are specifically designed to help us calculate the present or future value of an annuity. So again, the two basic structures we want to look at are a single cash flow or an annuity. All right, so are we ready for the next slide?
Yeah.
All right, so future value of a sum. We'll start here because this is the one that most people are familiar with. If I put money in the bank now, what will happen? If I leave it there, what am I hoping will happen? Or what do I expect to happen? Well, it better grow in value because what's the point of leaving the money there? In other words, I expect to earn interest when I leave my money in a bank account. And so the future value of a sum means if I put money in the bank now, how much will I have in the future? Okay, now, of course, this depends on knowing several key details. First of all, I need to know how much I started out with. I need to know how long the money will be there, and I need to know how much interest I'm earning. If I have all that information, I can easily figure out the future value of that sum. Okay. So now there's a lot of simplification going on here, by the way. The examples we'll be looking at are based on the assumption that the interest rate never changes during the period of analysis. If it does, we have to do something that's more complicated. But for here, we'll keep that simplifying assumption. So if the bank is offering 5%, we'll assume that that will be the case for as long as I leave the money there. Now, in order to calculate this, as I said, we need to know a lot of information. So we're going to start out with an algebraic expression that will enable us to solve for the future value of a sum. Okay. By the way, if you see this word tossed about compounding, that's what we're actually doing here. We're taking a sum of money and we're adding to its value over time. And this is called compounding. All right. So remember that word compound. We'll see it quite often in this section. All right, are we ready for our first example?
Not
Or at
yet.
least our first formula? All right, so this is an algebraic formula that will enable us to solve for the present value, the future value of a sum. And we have to introduce some notation here. All right, are we ready?
Yep.
Okay, so this is what it looks like. Okay, now some of it is pretty self-explanatory. FV means future value of a sum received at time t. In other words, t years in the future. Okay, that's this. All right, so if I put my money, let's say in a bank account for 5 years, I'm looking for FV5. Now PV is short for present value. And this is the amount that I started out with. This is how much I have now. I put this in the bank, and at some point in the future, the balance of my account is equal to FVT. Now, of course, as I mentioned before, we also need two other key details, R, which is the rate of interest. And by the way, whenever we use interest rates in an algebraic formula like this, we always express them as a decimal. We would, for example, 3% would be written as 0.03. And then finally, T is time in years. All right, so if I'm holding the money for 5 years, then T, of course, would equal 5. All right, so what this is telling me is that I'm taking the amount that I started out with, I multiply it by 1 plus the rate of interest, and I'm raising that to the t exponent. Whatever that number is my future value. Okay, now it looks kind of complicated, but you shouldn't have any trouble with it. Okay, are we ready?
Yes.
So here's the problem we want to work on. Let me repeat the formula here, by the way. We start with $1,000. We invested for 4 years. Let's say this is a bank account. The annual rate of interest is 3%. What is the future value of the sum? Okay, in other words, if I leave the money in my bank account for 4 years, how much will I have in 4 years? That's what we're really asking here. So that means what I'm doing is this. So in other words, if you notice, the rate of interest is 3%, but we're going to write that as 0.03. So here I've got 1 plus the interest rate. T, the exponent, is the amount of time involved. And then, of course, whatever I get in this expression, I have to multiply by the original amount, which is 1,000. And whatever number we get here is our future value. Or else, in other words, think of it as the balance of my bank account in 4 years. So I assume everyone has a decent calculator available to them. So why don't you go ahead and pop that into your calculator and let's see what you come up with.
1125.5.
Yes. It's actually, we're going to round it up to 51.
Okay.
Now, so in other words, if I put the money in the bank now and the interest is 3% per year for 4 years, I'll end up with 1125.51. Of course, since these are dollars and cents, these problems will always round to the nearest cent. Now, this tells me that of this amount, 125.51 is the amount of interest that I've earned. If I started out with 1,000 and the bank at the end tells me that I have 1125.51, that implies that the last 125.51 must be my interest. So you can see this really isn't that difficult, is it? It's not, but it can get complicated depending on certain conditions that we'll see in a bit.
So why'd you
But
put the 125.51?
that's the interest amount. In other words, at the end, this is how much is in my bank account, but I started with 1,000. The rest is my interest. Okay. Now we're going to do the exact same thing in Excel. Okay. So if you look at your spreadsheet on sheet 4, you'll see that there's actually two cells, and you notice it's the same exact example, 2 cells where we're going to solve for the FE. We're going to do it first with algebra, and then we're going to use Excel's built-in function. Okay. So let me do this real fast. Let me copy that formula again so you can see it. And then that way you can see why we're using the commands that we are using. Oops. So yeah, that formula, I'll put it right here. So here's how we're going to implement that in Excel. We're going to type equals. Now we're going to use cell references rather than typing the actual number. So the present value is here times 1 plus the rate of interest. And the exponent, which you know in Excel, the exponent is that caret key or shift 6. And then we're going to refer to the cell B3. Okay. So if you follow along with that, we'll get the right answer. Okay, let me just put that back. So make sure you're getting 1125.51. If you notice, I've already formatted it to round it to dollars and cents. So did that work for everyone?
I'm still typing in it.
Oh, okay.
I got it.
Okay, now the Excel version, let's go back to the slides for a second, looks like this. And so if you notice in the slides, I have all of the details here about how to use the Excel formulas. So this is what it looks like. Now, this is the general version of it. In fact, I'm going to copy this over here so you can see it. It always makes it way too big. So now here's what you're going to do. Type equals FV. The rate is in cell B4, comma. The number NPER stands for number of periods, which is the same thing as time. Fine. Payment, now put a 0 for payment. We'll explain that later. And for PV, what you need to do, now this seems strange, but we're going to make it negative B2. Okay, so that's what you should have. Now, why is it negative? We think of when we put money in the bank, cash is coming out of our pockets. That's an outflow. So we're going to treat that as a negative. At the end of the 4 years, the amount of money in the bank belongs to us. We can withdraw it if we want. That becomes a cash inflow. So we want the present value to be negative. We want the future value to be positive. All right. And if you hit enter, there it is. It's the same because it's the same formula. They're using the same algebraic expression that we did. All right. Did that work for everyone?
Yes.
All right. All right, good. So now we're going to turn our attention to the present value of a sum. Now, this is just the reverse of the future value. What is this for? Well, imagine the following situation. Suppose you, for some reason, you decided that you must have a car when you graduate. All right, you're like, listen, I'm tired of taking the bus. I've got to have a car. And there's a car that I want that's going to cost $10,000. But I'm going to graduate in 3 years. So how much should I put in the bank now to make sure that I have $10,000 in 3 years? That's what we're trying to do here. We're trying to reverse the future value process. Instead of saying we have X amount now, how much do we have in the future? It's the other way around. We're saying we need to have X amount in the future. How much do we need to save today? So these are actually inverses of each other. So algebraically, you'll see that this present value formula is just the inverse of the future value formula. That's all that it is. So you're taking your future value, you're dividing by 1 plus the interest rate, raising it to the t power, and whatever that number is your present value. So whatever it is, it's of course less than FD. And one more thing, what we're doing here is called discounting. All right, so I'll write that up here so you can see it. Discount. Okay, so now we're gonna have another example. And again, we'll do it in two different ways. We'll do it with algebra and we'll do it with Excel's built-in formulas. All right, I'm going to copy this to the spreadsheet, by the way. You don't have to, I mean, you can do that if you want to. It's not necessary, but I find that it's easier if you can just see what you're trying to do. All right, so here's the example. How much do we have to put in a bank now that pays 5% interest per year in order to make sure that we have $1,000 in 3 years? Okay, so in other words, this $1,000 is our future value. So now we're going to plug that in to our present value formula. And so here it is. It's going to be future value divided by open parentheses, 1 plus B11 raised to the B10 power. All right, are we all getting that?
I haven't typed it in yet.
Oh, all right, go ahead. When you're ready, let me know.
I did it.
Okay. Did you get 863.84?
Yeah.
Now that means if I put this much in the bank now, in 3 years, I'll have exactly $1,000. And that also means in turn that I'm earning how much interest? It's 1,000
Wait,
minus.
can you open the B12 again?
What was that?
Can you open the 863?
Yes.
Okay, thank you.
All right, good. So the interest is the difference between the two. $136.16 is how much interest we earned during that period. Now, as far as the Excel goes, once again, I'd like to copy the formula for you so you can see what's being done. And you can see it looks awfully similar to the future value, doesn't it? It sure does. They did that on purpose, of course. They want them to be as similar as possible. So now you're going to type equals PV. The rate is the interest rate here. Number of periods is time. Put 0 for payment. We'll get to that later. FV is this one. All right, are we ready? Let's see if it matches. Now, there's just one little twist here, though. It's showing up as a negative number. That's because, as far as Excel is concerned, you're putting this money in the bank, which means it's a cash outflow. It's treating it as a negative number. If
So
you
wait,
don't like
since it's
numbers, did you get the same thing?
since it's red, it's negative.
That's right. And here, red means negative. Now, how do you get around that problem? All you have to do is if you don't like, if let's say that I mean, you get it. You know that this technically is a negative cash flow. It's an outflow. In order to avoid having a negative, all you have to do is come over here and put a negative in front of PV because it is kind of annoying. All right. And then that'll just bring it up to positive 863.84. Yeah, just because you may decide, I don't want to be looking at negative numbers. I get it that this is an outflow, but I'd rather show it as a positive number. All right, how are we doing?
Good.
All right, good. Okay, so now we're going to turn our attention to annuities. Annuities are more complicated because there's multiple cash flows. And like I showed you before, if the payments are equally sized, and they occur every year, then we have what's called an annuity. Now, in practice, we sometimes have cases where the cash flows are equally sized, but they may occur every month. So in those cases, we could think of it as monthly annuities. Which technically is not correct, but if you're a real stickler for language, there should be another name for this, but it means that we have repeated payments every month, or actually repeated equal payments every month. So like I said, the reason why this is so important is because you see a lot of that in practice. If you go to borrow money to buy a car, for example, the payments you'll be asked to make are going to be exactly the same every month. Same thing with a mortgage on a house. So those could be treated as an annuity, although a monthly annuity because the payments are every month. So certain types of securities in the market make payments in the same way. For example, bonds in the United States, they typically pay interest every 6 months, and it's going to be the same every time. So you can think of those as semi-annual annuities. But anyway, let's look at our formula.
Did you go back?
Yes. By the way, here's another example you may have run into. No, maybe you've heard about this. You know that every state has a lottery. Okay, states raise a lot of money this way. It's a good way to raise money without raising taxes, because then people get annoyed with the politicians. If instead we have lotteries, then people are voluntarily playing this game, and their losses are going to the pockets of the state. What tends to happen is that when you get a very large prize, they rarely hand you a check for the full amount. They usually split it up into annual payments spread out over many years. And when that happens, then what you're actually earning is an annuity instead of a lump sum payment. Okay, so like if you won $1 million prize in the New York State Lottery, they might offer you $100,000 a year for 10 years. They don't want to hand you over $1 million right away. They split it up into multiple parts. So now, by the way, before we go any further, we have to be very careful here. There's actually two basic types of annuities we could run into in practice, the ordinary annuity and the annuity due. So what separates the two of them is when do they start? So this one starts one period in the future. And this one starts right away. And in practice, you do see both of these, although the ordinary annuity is the one you're most likely to run into. Like, let me give you an example. If you bought a car, the first payment isn't going to be due the minute you drive off your car off the dealership lot. It's going to be due probably the first month after that. So that means you're starting up an ordinary annuity, but other types of cash flows might take the form of annuity due. So we have to know which one it is when we calculate the present and the future value of these annuities. So let me just show you a quick, simple example of this. Let's say we have a simple case, $300 payments. This counts as an annuity because all the payments are equal. This one, remember, 0 is today. Then these numbers are how many years in the future. Two is 2 years in the future. And then finally, 3, of course, is 3 years in the future. Now, let me show you the next case, and let's see if we can notice what the difference is. Here's the annuity due, and here's the ordinary annuity. What did you notice about the two? Well, if you notice, this one starts one period in the future. In this case, the period is 1 year. And then this one starts right away. So if let's say this is a prize of some kind, which one would you rather have? The annuity due or the ordinary annuity?
The annuity due?
That's right, because you're getting your money right away. Exactly. But on the other hand, if this represents a repayment of a loan, which one would you rather have? Where you're making the payments, then you would prefer to start in 1 year, right? Absolutely. So we have to be aware of which one we're referring to when we have an annuity problem. It has to be clear whether we're starting right away or in the future, so we know which one it is. Now, there are formulas for these, of course. We start with the future value of an ordinary annuity, and this is the formula. It's a little bit messier than what we're used to seeing. because now there are two T payments instead of just one. So let me move this into the spreadsheet. And so we're going to do the same thing. Now, for this one, we're not going to do the algebra, although I guess we could. But I think it'll be easier to simply do Excel's formula, which is, let me show it to you. There we go. Now, by the way, if you notice, it's the same formula that we had up here. So what's different? Well, what happens is here, we actually did not use this command type. We left it out. That command type, or that value type, only is used with annuities. And not only that, but it can only have two different possible values. Number one means annuity due, and 0 is ordinary annuity. That's all we have to choose from. So when you're dealing with annuities, you have to specify which one you're talking about. If you're not dealing with an annuity at all, you can just leave that out. Okay, which is what we did up here. We did not use this type input. But down here, we have to. All right, so here's a case where we have a sum of $1,000 is invested each year for the next 4 years. Okay, so in other words, instead of putting money in the bank once, we're going to put the same amount in the bank every year for the next 4 years. That's how I know it's an annuity, because it's $1,000 each year, not just once. And I want to know how much I'll have at the end of the 4 years. By the way, here's a helpful hint. Since I put $4,000 into this account, the future value will be a little bit more than 4,000. It has to be, because I'm earning interest. The question is how much more. So those numbers are repeated here. And so what we're going to do is use this feature, FE. So the rate is here. Oh, I'm sorry, we're doing the wrong one. It should be this one. So the rate is the interest rate here. Number of periods is time. Now, here's something interesting. Payment, PMT, again, this is only used with annuities. Let me do this here before I forget. This payment, before we kept setting it equal to 0. Okay. Now, if we have a payment like this PV set equal to 0 for annuities. So if we have an annuity, we must use the PMT command, but we must set the PV equal to 0. Okay, so let's do that. So we'll have FE, the rate is the 3%, the number of periods is 4. Now C, if you notice over here, I've labeled the C. C is the repeated payment, or the annual cash flow in this case. B18, 0 for PV, and because it's an ordinary annuity, the type is 0. Okay. Are we ready?
Yes.
And it's negative. If you want to get rid of that, just put a negative in front of FV. So we have 4183.63. So those 4 payments plus the interest that accrued on them adds up to 4183.63. Okay. Did we all get that?
Yes.
Now, with the annuity due, we only make one change. The type has to be switched back to 1. Okay, so remember, it says it over here. Annuity due means the type equals 1. So watch what we're going to do. The rate is here. The number of periods is here. The payment is C. But remember, PV is automatically set equal to 0. Now the last number is 1 instead of 0. That's because it's an annuity due.
So why'd you put a lowercase b24 instead of uppercase b20?
Oh, I'll tell you what, the case is not relevant with Excel. It's going to switch it over to capital B anyway. So, it's not something you don't have to worry about. Whether you put lower or uppercase, it will automatically convert it to uppercase.
$4,309?
There you go. Oh, I keep forgetting about the negative. I don't know about you, but I would prefer not to have to see that negative. So I'm going to put a negative here. And yes, it's approximately, it's 4309.14. Now, if you notice, the future value is higher or greater for an annuity due because cash flows begin 1 year sooner. So therefore, you earn more interest. Okay, that's why this is happening. All right, how's so far so good? Yes.
What are our cash flows?
Well, because this is an annuity, that means we're either putting money in the bank every year or else we are withdrawing it every year. So the cash flows are the annual or repeated cash flows. Remember, here we're putting $1,000 in the bank every year for 4 years. Those are the cash flows. All right, so now we're going to consider 2 types of present values for annuities, ordinary and annuity due. Okay. So here's our example. Now what's happening here is that we're trying to figure out how much you would have to put in the bank now to be able to withdraw C dollars every year for the next T years. So in other words, imagine yourself planning for your retirement. And you say to yourself, when I hit 65, I'd like to be able to withdraw $100,000 from the bank every year for, let's say, 20 years. That's what we're trying to figure out here. How much do I have to save to make this happen? So, and again, there's a complicated formula here that we can do this algebraically if we choose to do so. But we're not going to do that today. Instead, we're going to use Excel's formula. You can see why. It's kind of a mess. But here's the Excel version. And again, you notice how it's the same formula that we had earlier for PV, except this time it's being treated as an annuity. Okay, so let's do this. So in this case, they want to know how much do we have to put in the bank now in a bank that pays 5% per year in order to be able to withdraw $1,000 in each of the next 3 years. Okay. You can easily see this being used too for college planning. You might say, well, how much should we put away now to make sure that we can withdraw X dollars a year for the next 4 years, let's say, during college years. So here, we're going to put some amount of money in the bank. such that we can withdraw, oh, I'm sorry, I'm in the wrong spot. $1,000 each year for the next 3 years. Now, this is an ordinary annuity because the first cash flow starts in 1 year. In other words, if you notice, the first cash flow takes place next year, and that makes it an ordinary annuity. And so that means the type equals 0. So let me remind you, 1 equals annuity due, and 0 equals ordinary annuity. Also, we use MPMT is the annual cash flow. But just like before, set equal to 0 or an annuity. So you're basically using PMT instead of FV. So in other words, here you're going to type PV, rate, number of periods is 3, the payment is C, which is in cell B30, FV is 0, and this is a type 0 because it's an ordinary annuity, as you can see up here. All right, are we ready to see what this
No.
number is? Okay. All right, let me know when you're ready.
Ready?
All right, okay, I'm gonna get rid of the negative. Did you get 27, 23.25?
Yes.
All right. And then one last case, we're going to turn this into an annuity due, which means all we have to do is change the type to 1. So the rest is exactly the same. The rate, the number of periods, payment, 0 for FE, and now change this last one to 1.
$2,859.41.
That's the one. So now everything you ever knew about time value of money, either this is new to you or it's review, but either way, you're all caught up. So anytime they decide to throw questions like this at you in the mind tab, you can come back and refer to the spreadsheet because you have all the cases you could possibly need here. All right, this covers them all. So now once you go ahead and save this and fire it over here, okay, I just want to make sure you got this part as well as what we did on Monday. And then we can dive into chapter 3. Which I don't think 3 has any Excel examples, so but we'll see how it goes. But we definitely won't have time to finish 3 today. We'll just get it started, and that's why I said I've postponed the chapter 3 problems until the following week, and we'll see how that goes. But you can still work on it this weekend if you want, but it's not absolutely necessary.
So we have 2 homeworks due next.
Yes, but I might change that. I might push some of those ahead too. So
Okay.
technically, yes, but when we get to that point, I might have to move some of it ahead in the future again 1 more week. I'm going to try to avoid having you have too much during any given weekend.
Mhm.
So this way you can enjoy your 3-day weekend. Which hardly anyone knew about. Yeah, I guess I don't remember them ever having President's Day off. They must have decided at some point, let's have it off. But they must have realized that a lot of people would not realize that because it's the first time. So that's why they sent me that email and said, listen, don't forget, we're off on Monday. I can't imagine any other reason why they would have done that. So don't come to class on Monday. All right, now let's go get the slides for chapter 3. And here we're starting to introduce or take a look at securities markets where all these securities trade, stocks, bonds, et cetera, et cetera. So some of this is more involved with regulations. And it's not necessarily the most exciting topic in the world, but we need to understand how this works. And oh, you know what we forgot to do? We forgot to look at what's going on in the markets today. Let's quickly take a look at CNBC. Ooh, now this is bad news. The inflation rate must be higher than they thought. Oh boy. Consumer prices rose 0.5% in January. Now that's bad because the target for the Federal Reserve is 2% for the entire year. If it's already 0.5% in January, we're not going to meet that target, are we? So that means the Fed can't cut interest rates like they thought they could, because otherwise inflation will get even worse. And keep in mind, the Fed's number one job is to keep inflation under control. So that means that they can't cut interest rates, that will reduce the stimulation that we're expecting for the marketplace, because interest rate cuts are very stimulative to the economy. So that's not good news at all. All right, so your portfolios may have suffered a bit because of this. In fact, why don't we go look at them for a second? Oh, wait a minute, what happened? All right, so let's go just a quick look at the standings. Um, oh, I couldn't see it because this thing was in the way. All right. No, some people are still doing pretty well. Nobody's really getting hammered, I guess. I guess it depends on which stocks you owned. Um, but Alex already made 0.5%, nice, and Susie is up 0.25%. So that's not bad for just a couple of weeks. And nobody's lost even a full percent yet. So far, so good. We have a close race, let's put it that way. But all right, anyway, let's get back to three. Now, of course, a market is simply a place where buyers and sellers get together to exchange goods and services, or, maybe securities. Now, it says here, if you notice, a market does not have to have a physical location. That's an interesting point. In the early 17th century, when the Dutch landed in New York City, or what is now New York City, they, unlike the Puritans or the Pilgrims who landed in Massachusetts, they came over here for religious freedom. The Dutch came here for one purpose and one purpose only, and that was to make money. Okay, they were all business people, basically. And in early days, they already were trading stocks with each other because they all represented different companies. A lot of them worked for the Dutch West India Company. And it had, its own shares of stock. And so they would stand around on the street corners in what is now the Wall Street district, and they would literally buy and sell stocks among themselves. There was no building. They just went to the corner there of Wall Street and right roughly where the New York Stock Exchange is now, and they stood there and they traded stocks with each other. Eventually, they found a location where they could do it inside, but in the early days, they were trading stocks without a physical location. Okay, so you don't have to have a building for this to happen. As long as people are actively trading with each other, we have a market. Okay. Now, a market makes it easier
Could
to
you go back?
trade. Oh, yes. Imagine you had a share of stock you wanted to sell. It's important that there's going to be people out there somewhere who are willing to buy it. Okay. In other words, it doesn't do any good to try to sell a share of stock if there's nobody who's willing to buy it. So the market is where all the people get together who want to either buy or sell. And this is also where a lot of information is exchanged about the markets themselves, what's going on. You hear rumors, get information about what's happening with these companies. And so, market is a good place to not only buy and sell what you're looking for, but to also get inside information about what's happening in the marketplace. Especially now, keep in mind, in the 1620s, there's no computers, there's no internet. People tell each other what's happening in the market. That's how they know. They hear things from each other. All right, we ready?
Not yet.
So the markets are what make it possible to buy and sell goods and services, but also securities. Okay. Now, in this day and age, if you want to buy or sell a stock, you can go online, you can get into your Robinhood account, whatever you have. It's easy. But here, in the early days of New Amsterdam, the only way that could happen is if everyone got together in the same place and they physically traded their stock certificates with each other. Okay, what is this getting us? Why are markets so helpful to the economy? Well, because it provides information. When I go to that market with my stock, I'm going to find out pretty quickly the price that I can sell it for. And that's an important piece of information. I'll know if my stock is going up in value or if it's going down. It also provides liquidity, which means that I have the ability to sell my share very quickly or possibly buy shares that I want without it taking a long time or being expensive. And so the more efficient the market is, the lower the transactions cost will be, meaning the cost of finding a buyer will be much lower than if I had to do this myself. And prices will adjust to all the new information that comes into the market. All right. Now, by the way, here's a little interesting historical footnote. It's hard to believe, but up until 2001, stock prices in the US were quoted as fractions. In other words, if I looked in the Wall Street Journal, I might see a price like this, 101 and 12/30 seconds. What is that supposed to mean? Well, that actually means $101 and 12/30 seconds of a dollar, which if you pop that into your calculator, is 37.5 cents. So we would quote it. Well, we would round it. But, I don't know if you're aware of it, but there was a time up until, let's say, just before the Civil War, we actually had 1/2 cent coins in the United States. So you actually could have had a price like that, 101.375. That was not a problem. Now, of course, as you know, just the other day, it was announced that we're not going to have any new pennies because it costs too much to make them. It doesn't mean we won't see any more pennies. It just means there won't be any new ones. There's no real need for it. I mean, come on. What do we do with our pennies? What do you do? You throw them in a jar. You try to get them out of your pocket because they waste so much space in your pocket. And besides, who uses cash anymore anyway? So, nobody's going to really be all that concerned that pennies are not being produced anymore. So, but yes,
Okay.
decimal pricing. Oh, yes. Decimal pricing means dollars and cents. Okay, now another interesting historical footnote here. When the US broke away from Great Britain, the British monetary system was 1 pound equals 240 pence. Now, Thomas Jefferson thought, that's absolutely ludicrous. And he's the one who came up with the idea of having a decimal currency, meaning that $1 equals 100 cents. Now, the British kept that system until 1971, at which point they also switched so that now, even for them, a pound is worth 100 pence. Okay. So you're probably wondering, like 240 pence, what a bizarre amount. But there were important historical reasons for that. Okay. By the way, imagine how your calculator would react to a price like 101 and 12/30 seconds. You can see why it was so important to switch to decimal pricing. Now, here, this is very important right now. When you buy stocks, let's say I go into the market and buy a share of Apple. I go to my Robinhood account and I order 100 shares of Apple. The secondary market, well, let's put it this way. The primary market for stocks is where the issuer sells stocks the first time, or new stocks. Let's put it that way. Sells new stocks. Now, when this happens, the way it normally works is the shares are typically sold to an investment bank, who is known as an underwriter. So if Apple, let's say, wants to issue a million new shares of stock, they don't sell it themselves. They have an investment bank, let's say it's Goldman Sachs, and they'll say, listen, Goldman Sachs, we want to sell a million new shares. What Goldman Sachs will do is they'll buy the shares from Apple and then they will turn around and sell them to the public. So the market where Apple is able to sell its shares directly to Goldman Sachs is called the primary market. The secondary market is where investors buy the shares from each other. When you go out into a Robinhood account and order 100 shares of Apple, you're buying them in the secondary market. And so the issuance of shares only raises new funds for a corporation in the primary market. So when the investment bank pays for them, secondary market, when I buy Apple shares, I'm buying them from somebody else who already owns them. Okay. I don't ever find out who that is, but I'm just buying them from somebody else. So the secondary market does not raise any new funds for the corporation. That's it. Once they sell them to Goldman Sachs, that's it. That's all the money they're going to get. At that point, it doesn't make any difference how high or low the stock price goes. The amount of money they collect is settled, and that's the end of it. So when you and I buy stocks, we're doing so in the so-called secondary market. So just so you know that. So the primary capital market, this includes everything, not just stocks. We have bonds, preferred stock, common stock, whatever it happens to be. The initial issuance is done in the primary markets.
What
After
does
that,
municipalities mean? Munis?
oh, municipalities are city, state, and local governments. Like the city of New York is a municipality. The county of Westchester is a municipality. Okay, and anything lower than the level of the federal government, the state of New York could be considered a municipality. So they all have the power to issue their own shares, their own bonds rather.
Say that
But
again, means what?
it's local governments. In other words, state governments, city governments, county governments. Those are all defined as municipalities here. And they all have the ability to issue their own bonds. Okay. And you know, you can see why. Like I've mentioned this before, I think the state of New York, in order to pay for the new Tappan Zee Bridge, they would have issued bonds. They wouldn't have had $2 billion floating around. They would have needed to issue bonds, and the investors buy the bonds. That money is used to pay for the bridge, and then taxes, future taxes, pay for the interest to the bondholders. Okay. Now, we typically treat the bond markets as the main segments of the bond markets are corporations, local governments, and the federal government. Okay, the federal government issues more bonds than anyone else because they always have huge deficits. So the government issues bonds that are collectively known as treasury securities. But interestingly enough, there are different kinds of treasury securities depending on how long before the investment is repaid. So in other words, with a bond, you're lending money to the issuer for several years typically. And then during that time, you get interest payments and eventually you get your investment back. So in the government treasury security market, we have treasury bills that have maturities of 1 year or less. Treasury notes go out 2 to 10 years, and then treasury bonds are anything beyond that. Although at this point in time, the maturities here do not exceed 30 years. All right, that's the treasury market. Now, municipal bonds can have many different features.
Did you get back?
Yes, because they're all a little different. The bonds issued by the state of New York are going to be a little different than the bonds issued by, let's say, the city of LA. But this market is enormously large. It's also one where it's easier to buy and sell these securities because the markets are very liquid. So when governments issue bonds like this, what they're trying to do is cover their debts. Okay, they owe money, and this is one way they can cover those debts.
What do the maturities mean again?
Oh, that's how long it takes before you get your money back. So if you buy a 30-year government treasury bond, you're going to get interest payments for 30 years. And at the end of those 30 years, you'll get your initial investment back, which is typically $1,000. All right, you ready?
Yes.
Now, corporate bonds are normally sold in order to raise money to run the business. In other words, a corporation issues bonds for projects that they hope will make money for the company. Like a typical example would be Apple. You know how every year they've got a new iPhone coming out. Well, they must spend a fortune developing the new iPhone every year. Where do they get the money from? They issue bonds to the public. So, can you imagine what it must cost? Let's see if we can get an estimate of that. How much does it cost for Apple
Will
to
you go
develop?
back to the slide?
Yes, I just want to look this up real fast.
All right.
Oh, for God's sake. Oh, all right, never mind. I thought I could get a quick, all right. So which slide? This one?
Yes.
Okay, so, all right, let's say it costs $10 billion to build a new iPhone, to develop a new iPhone. They're gonna need to get the money from somewhere. So usually what ends up happening is they'll issue new bonds, and that means they're borrowing money from the public. They pay interest to the owners of the bonds for a fixed number of years, and then they reimburse the bondholders. Often the amount of money involved is $1,000, but it can be more than that. All right, are we good?
Yep.
All right, so given how late it is now, keep in mind, remember, we're not going to meet again until next Wednesday. So in the meantime, you can feel free to work on your mind tap if you want to, or go as far as you can, but you don't have to. They're not due this weekend after all, because we're not obviously done with chapter 3, although I expect to wrap this up fairly quickly next week, and then we'll start 4. So I may have to postpone the chapter 4 assignments as well. You can see
Are you
this
available
hasn't,
this Sunday?
yeah, I'll be here. I'll let you know
Okay.
what time. Um, so this is gonna probably have a ripple effect on all the later assignments. I may have to keep making adjustments, but I'm just trying to make sure that by the time an assignment is due, we've actually covered everything you need to know to do the assignment. So that means 3 has to get postponed, and because of the holiday, I'm guessing that 4 will probably have to be postponed as well. So it means you get a little extra time off, but we'll get it all done very quickly. You know, what are you gonna do, So, all right, anyway, so I'll see you all next Wednesday then.
Thank you, Professor.
Thank you.
All right, see you later. All right, bye.
Thank you, Professor. Have a good day.
Okay, you're welcome.